So there's two companies, Alameda and FTX. And so here's how it works. As a matter of fact, I'm going to read you directly from Sam Bankman-Fried, SBF. He's the founder of FTX and Alameda. And he actually explained exactly how it works in an interview on April 25th, 2022. Now, if you've been listening to the podcast for a long time, since April, I originally read this to you back then, but I'm going to read it to you again here. So this is directly from his own mouth, okay? He says, okay, the cryptocurrency world is split into two. This is not from him yet, but the cryptocurrency world is split into two different visions. One group of fundamentalists seeing some coins, like Bitcoin, as unchanging static lines of code that can active stores of value. So that's Bitcoin. Bitcoin's over here. And then there's another group experimenting at an increasingly frantic pace with new ways to create money, right? Bitcoin and crypto, they're not the same. Bitcoin is a static line of code that's a store of value. The other one is frantically trying to create money out of thin air. Okay, so now let's talk about this interview, and I'm going to read directly quoting Sam Bankman-Fried. So here's how it works. You start with a company that builds a box, and in practice, this box, they probably dress it up to look like it's a life-changing, world-altering protocol. So what he's saying is you start with a box. So a company, that's the key piece, a company, remember that. A company builds a box, and they dress it up to look like it's a life-changing, world-altering protocol. So all these cryptocurrencies, they're protocols, right? They're software. They're going to change the world, which is exactly what he's saying. So a company builds a box, and they dress it up to look like it's a life-changing, world-altering protocol, okay? Then it says what it does, or it pretend it does literally nothing. It's just a box. I'm reading directly from him. So they create a company, they create a box, they say it's a world-changing protocol, but the box does nothing, it's just a box. So what this protocol is, it's called Protocol X. It's a box. Now you take a token, all right, and you can take Ethereum, you can put it in the box, and then you take it back out of the box. So you put money in, and you take money out. You start doing this to create activity. That's me ad-libbing here. Now I'm going to go back to quoting him. Quote, it doesn't do anything, but lets you put things in it if you so choose. Then this protocol issues a token. We call it whatever, call it X token. And X token promises that anything cool that happens because of this box is going to ultimately be usable. So, and now let me ad-lib again here. So you create a box, a company creates a box, and they say it's going to change the world. Then they start putting tokens in and out of the box, like Ethereum, in and out of the box, so there's like some activity. And then they create a token for this box, and this token promises that anything that happens that's cool with the box is going to be usable. Now, we don't know what that is. It's going to have utility, though. We promise. We don't know what the utility is, but don't worry, it's going to have utility. Okay, this is how it works. Quote, and of course, so far, we haven't exactly given a compelling reason for why there would ever be any proceeds from this box, but I don't know, maybe there will be, end quote. Okay, quote, and then you say, all right, well, you've got this box and you've got X token. They're going to give them away for free to whoever uses the box. End quote. So basically, you've created this token, you create a company, you create a box, create a token, you pretend that there's stuff going in and out of the box, you're putting money in and out of the box to pretend there's something there, and then you create this token and you say, hey, anybody else that puts money in this box, we'll give you this token that we created out of thin air, and we're going to give it to you, all right, if you use the box. Quote, X token has some market cap, right? It's probably not zero. Let's say, it's 20 million market. At this point, the interviewer, Matt, says, wait. From first principles, it should be zero. Sam Bankman-Fried says, sure, okay, completely reasonable comments. The interviewer, Matt, says, when you describe it, it sounds like it should be zero. Sam Bankman-Fried says, quote, you might think that in 5 minutes with an internet connection, you could create such a box and such a token. So Sam Bankman-Fried says, yeah, you might think it should be zero, and actually it probably should be because I could create this in 5 minutes. If I had an internet connection, within 5 minutes, I could, quote, create such a box and such a token. It should be worth $180. That effort that you put into it, in the world that we're in, if you do this, everyone's going to be like, oh, box token. Maybe it's cool if you buy in box token, that's going to appear on Twitter, and it'll have a 20 million market cap. One thing that you could do is you could like make the float very low. There haven't been $20 million that have flowed into it yet, end quote. So he's saying, yeah, it should be worth nothing because all you need is an internet connection and I could make this in 5 minutes. That's what he said. But because you tell the world, oh, if you buy this box token, it's going to be worth so much money. And then he says there'd be a very low float. So what does that mean? So a low float meaning you create, let's say, 100 million tokens. And of the 100 million, only a very small percentage are actually available to trade. So out of 100 million tokens, you take, 5,000 of them, like almost nothing. The rest get locked up. Of the 5,000, you start trading. And through wash trading, that means I trade in and out by myself. So I sell it to my buddy, and they sell it to their buddy, and I buy it back, and then it goes round and round and round. And because it's such a very thin amount, it's very easy for me to push the market cap or the valuation of a token that's very thinly traded up. Now, the interviewer says, quote, it shouldn't have any market cap in theory. And Sam Bankman-Fried says, quote, that's right. So it shouldn't have any value because they just made it up and it didn't cost any money and all they had was a computer and internet and they did it. And we've artificially created it and it shouldn't have any value. And Sam Bankman-Fried says, quote, that's right. Continuing, quote, obviously already we're sort of hiding some of the magic impact, right? Some of the magic is in like, how do you get that market cap to start with? But whatever. We're going to move on from that. X tokens are being given out each day. All these like sophisticated firms are like, huh? That's interesting. Like if the total amount of money in the box is $100 million, then it's going to yield 16 million this year in X tokens being given out for a 16% return. So what he's saying there, end quote. So what Sam Bankman-Fried is saying is, you're right. It shouldn't have any market cap. But we're hiding some of the magic. And he says, X tokens are being given out every day, and these sophisticated firms are like, huh, that's interesting. These sophisticated firms are the venture capitalist firms, and this is a key piece. So venture capitalist loves cryptocurrency because they can buy these fake imaginary tokens and instantly make, in this example, Sam Bankman-Fried quoting him, says they could make 16 million this year. So typically venture capital has to lock up money for 7 to 10 years. And hopefully if this company really changes the world, they'll make that money back. But with crypto, they can put it in and instantly make 5, 10, 20, 30 times on their money. They loved it.